Right, very, very good morning to everybody, and welcome to week 48. Hope everyone had a fantastic weekend, and for the Americans, the American linked Thanksgiving hauls. Hope you also had a very fantastic break with family, friends, and frenemies. So, basically, title of this week is 5 weeks into year end, but really, in reality, it's more like 3 weeks, just kind of given seasonal kind of end of stuff. We are joined, obviously, by the very talented James Kim, who will be walking us through a lot of the charts and technical analysis and so on. There is no caught report, just given the Thanksgiving weekend, but we have something else to run through. I've promised a bit of a teaser in regards to the run up to the official kind of outrageous prediction. So we're going to have a little version of Macro Monday that quite a few of you have also kind of sent in, which would be quite a bit of fun to kind of go through. So with that, let's kind of step in. Obviously, everything kind of covered here is solely views, opinions, not trading, no investment kind of recommendations. That's kind of rehash of last week. What started off as kind of a quiet Thanksgiving week, really first thing was Monday morning was, of course, the news kind of coming out of Germany with the failed kind of coalition. We've kind of gone from zero to hero on this, with everyone kind of focusing on Merkel's kind of downfall, potential kind of call for re-election, but now things seem to be a little bit more on the mend, and that kind of turnaround, if you will, in regards to prospects of a coalition being formed, as well as kind of the divergence between economic data in the U.S., which was pretty poor last week in regards to what came out, versus very, very strong economic data coming out of the Eurozone, very strong beats on both manufacturing and services across multiple regions. Saw basically euro-dollar reverse close back above 119 at 119.33, and dollar-yen kind of sub 112. So DXY was down about 94 basis points for the week, and kind of really has broken that US dollar back, if you will, in regards to kind of a melt up. Also, given just the positioning is really not there. To top that all off, we also had FOMC minutes, which were basically construed as dovish, so that sentiment is still very much against kind of the US dollar. On the yields, interesting to see that still no real delta on the US 10s. We're kind of 233. Bunds at 36 at tight. We actually have a trade in regards to kind of that, but definitely not aligned with the move up that we saw in euro dollar. No doubt this is a little bit more tied to kind of the feeling kind of Germany. I'll touch on that later on. And again, very, very significant close on euro dollar and just dollar crosses in general, which JK will be touching on as we kind of go through the charts. On the energy side, continue to shine on WTI, 6.5 for the week. Who would have thought would have been 58.95, just shy of $60. And this is on WTI, not crude, mind you. And this was kind of on the back of, I think just a combination of US dollar weakness, but primarily due to kind of the pipeline closure in North America, due to kind of the leaks there. But very different story in natural gas, which was down about 8%. We also saw nickel and copper quite well bid. Surprised that gold and silver maybe didn't do as better as expected, closing down for the week, but I'll touch on that a little bit later on. Equity side, bull market, dude. Continues to kind of grind up, pick you across. They're up, making new highs in the U.S. And even though we had a little bit of a shakedown on CSI 300 in China, down about 3% on one of the days last week, it still only closed down about 40 basis points per week. And of course, vol getting back into kind of compressed territory. We're now sub 10, down about 18% over the last 5 trading sessions. So interesting to kind of note that. So, 2 seconds. Okay. Let's see if that seemed to be having some kind of technical issues with the sound coming through. Hopefully this will get a little bit better. Apologies for that. On Macro Monday for the week ahead, basically, there's quite a lot on. We have both the combination of OPEC, which is going to take a lot of, obviously, attention kind of going through, as well as final PMIs and ISMs, a host of those coming through on Friday. The German politics will continue to kind of be key. And there is also this kind of weird theme, I thought at least, where we seem to have quite a bit of financial stability reports, RBNZ, BOC, BOE, Bundesbank that's going to come through across this week. What's going to be interesting to see if there's any kind of commonality here, whether something's trying to be communicated in chorus or if it's just coinky dinky, which it just doesn't seem to be like that to me. At least I can't recall seeing so many stability reports, stress tests coming out during the same week until you kind of flash back to kind of the GFC time. No main central banks meeting apart from Bank of Korea, where markets not expecting anything. It would be quite something if they did actually hike, given how strong the won has been. But also for the emerging market banks, it is actually Kazakhstan, which is actually looking to cut, at least that's expectations. Quite a lot of Fed speakers out this week. This is probably the last week before kind of going to blackout. So Dudley will be out with Mnuchin. Um, Powell will be up before he should be getting sworn in. I believe this week we do have the Senate back in from Thanksgiving. So actually another thing that I actually didn't put up here on the key focus is of course going to be them trying to get the tax kind of reforms through. I still think that's going to be more of a first quarter 2018 issue, especially with some of the new shenanigans that they've tried to do with sneaky kind of healthcare kind of provisions towards into that. And from a few other speakers that are watching out for, obviously OPEC is an all-day event on Wednesday. But we have Paulos, as well as RBNZ Spencer, and of course the Bundesbank Wittmann speaking on two separate occasions. Already covered the ISMs and PMIs being key. We do have quite a few GDP readings from the like of the U.S., Canada on a Super Friday kind of basis there, as well as also coming out of Europe with I think the likes of Sweden, if I recall correctly. PCE is always going to be key. 1.5 is expected on headline. On the core, it's 1.4. And of course, ISM will have a little bit more watch, just given how the U.S. failed, or should I say, missed the flash PMIs last week. And it's also obviously going to be worth watching the Kaizen manufacturing for China later on kind of this week out here. So that's going to be quite key. And again, Canada is also going to have jobs data on Friday, which is always quite key on that kind of regard. So 1, 2, 3, 4, 5 weeks to technically go into year end, but in reality, it's more like 3 because once you kind of get into mid deck, people have reduced already risk. People are already kind of vacationing. I was already trying to put some meetings together for second week of December, and is already people just not around. So only 2 more macro Mondays before we return kind of in mid-Jan. It is worth noticing again, keep talking about Fed Deck 13th is really the key next date. 92.3 is the implied probability of deck hike. Currently, the Jan 2019 Fed Fund futures, if you recall, we've been advocating shorts in these all the way from like 98.55, 98.60, but it's barely pricing in 2 hikes. So it's pricing obviously the December 13th hike at about 30 basis points for the entire 28th and for the entire January 2019. So it's been quite a bit of a rock and roll trade. I'm just again continue to be amazed by how much the market kind of always keeps second guessing the Fed. It feels this whole regime, every Fed hike has just kind of been questioned, tried to be faded. What is interesting is we've continued to recently make new lows, lower lows, if you will, on the Jan 2019 Fed Fund futures. Yet this is despite not really seeing 10s and 30s kind of breaking higher, right? We also got the announcement from Yellen that she'll be stepping down in February from the Fed after Powell has signed on. So I believe this will actually only give her the December 13th meeting. They didn't give a date for February, but the first meeting from the Fed is in February kind of next year. So I believe Powell will probably chair that one. And I'm actually not even sure if that's just a statement or actually it has to have a press conference also tied to that. Cryptos, again, this is a plug-in from last week. We do have webinar that's linked up on the November 30th. I put the registration link is here. I also put it out on the chat. Hope everyone got that. We are making new highs in Bitcoin. We are about 9,500 all-time new highs. I've been talking about how colossal the CME futures event is on a +5 to +10x return over the next kind of 6 to 18 months. We initially seem to have had a DEC 11th official date from the CME. That seems to have been taken down from their website. My traders here are also asking me to manage expectations from clients because obviously we'll only be able to operate if, of course, our prime brokers are also on board. And all of this is still kind of unclear. So a lot of people are watching this space for clarity. So just something to bear in mind. But hopefully join us on for the webinar that JK, myself, and a lot of other people around the region will be pushing for. It's going to be a little bit of an introduction into the space, some introspection, some thoughts and valuation, some coverage of ICOs, and hopefully a little bit of something for everyone. In regards to protection, again, same thing. I think I'm going to leave this on till the end of the year. Still think a lot of these things make sense. Bresler was already advocating short dollar yen from about 2 weeks ago. These have worked out very well if you had puts and put spreads kind of there. Ditto on dollar Swissy, ditto on the Nikkei. HYG, EM still probably have not moved as much, especially kind of the former. So these, I think, are just ways of thinking how to, potentially have a good break, not be tied to the screen. Year to date, if you've had a very long only bias, you've done very well, anything from plus 15 to plus 30%, again, depending on how you constructed your port. But it is worth thinking about some kind of year-end protection. I think on German elections, as I kind of alluded to at the beginning, the most important thing from my perspective really is Draghi and the ECB, and that I think is going to be very much intact for 2018. His term does not come into expiration until 2019. I was already a little bit more bullish on this than most people last Monday. Whether that's luck or not, it does seem that Merkel, there is still a chance of a grand coalition being done, being kind of paved out. So we still have to wait out for that. But we have to kind of wait and see how this kind of goes, as an election cannot just be called very, very quickly, just given how the Constitution and everything is kind of construed. It is worth noticing, though, that our chief economist, Dean Jacobson, puts the chance of a new German election at 60%, so something to just bear in mind. On that thinking, we do have a new short in the strategic book, which is basically being short bunds, thinking that probably the move up in euro dollar is the right move, given the strength that we're seeing in kind of the eurozone, the posturing from the ECB, the posturing from the Bundesbank, as well as also maybe a potential start of potential kind of weakness in the U.S. side. But net, global yields are going up higher, and just feel that this knee-jerk reaction, if you will, on lower bunds is just more related to kind of this German kind of election, which I don't think structurally changes anything. I would even go so far to say, if let's take a worst-case scenario, the new elections, Merkel loses, probably a new kind of mixed government will be more fiscally stimulative, if you will, wanting to do more for the Germans. We'll probably hold back on immigration. We'll probably want to, more kind of tighter kind of monetary policy. I mean, all of these things, at least on the fiscal side, the spending will be a lot more inflationary, as well as also curbing immigration, so to speak. So again, a worst case scenario, it's still in my mind constitutes to more weighting towards kind of yields moving up, if you will. So I think short bunds or that kind of thinking, that kind of thesis, to me makes a lot of sense. So this should have come out a lot smoother than it did here. I think this is just on the uploading, so apologies for that. But basically, we're going to have our official 2018 outrageous predictions out, I believe, in 1 to 2 weeks. I know they're done, but it just has to go get officially toasted and then out. Steen Jacobsen will be touring the globe, kind of banging the desks on this. It's probably our most well-read and popular kind of piece. He'll also be out here in the Asia Pacific. But I'd asked, obviously, a few of you on the Macro Monday to just give in your 2 cents. I'll quickly kind of run through these in no kind of specific order. Interesting to obviously see a lot of Trump and a lot of crypto and a lot of the stuff that kind of came through. We have Trump being impeached. We have Trump not being impeached. We have Bitcoin will not be worth 8,000. It'll be worth 800 or 80,000. So that's, I think, quite interesting. We have Apple, and I guess that theme of tech breaking into kind of banking and eating kind of the market share of what has traditionally been in kind of the investment bank and commercial bank territory. This is probably something that we've already seen out here in Asia with the likes of Alibaba and Tencent, who have a very, very different approach to, let's say, traditional European and American kind of tech companies, kind of in the same kind of theme of disruption. This one here is Amazon disrupting kind of the pharma sphere, going so forward as to not only do the deliveries themselves, but also basically write down the prices, so bring in some more kind of price competition, something that probably everyone would agree is very, very much needed in the U.S. Obviously, also the view here that Bitcoin and crypto basically is reduced to rubble, basically from a combination of incumbent banks, central banks potentially conspiring against them. And one that I really kind of liked was actually from our man Brezzi here. Was this actually is an early Brexit deal? This is probably something that not a lot of people are thinking about. Most people, including myself, probably thinks it takes longer than is expected. Inflation in the U.S. rising over 4%. Probably Fed would wake up screaming on the back of this. Tesla hitting 200. It was basically at 316 at the close of last week before Thanksgiving. Thinking here is that other automakers basically rush in a lot more aggressively to compete in the electric kind of car sphere. We've already seen a lot of governments put out legislation saying that they want to have X amount of cars running on renewable energy by 10, 15, 20 years. Very aggressive targets, and these are not just in the Scandies. We also seen these out from the likes of China. We have the view that Merkel and her supporters are out, very different from what we just talked about. We have this view, which I think is great. Nothing happening in 2018. No bust, no recessions, just steady chugging along of global growth and equities grinding up. We have this, which is one that I have, which is a sterling Swissy. That's sterling Swissy doing plus 20% in 2018. That's unlevered. This is just based on the fact that over the last 2 to 3 years, it's had two specific systematic shocks that has taken sterling Swissy much lower. I'm obviously talking about the depegging on the Swiss National Bank. 2-3 days before they said they would never remove it, and of course the Brexit kind of vote. So that's plus 20% unlevered from these 130.60 levels. It is a positive carry trade, and I think off the top of my mind, if you take the 30-year quarterly median level just to re-rate back to the median level is like a 70% move, which I think is something that's going to happen over the next probably 3 to kind of 5 years. But I do think you'll have a few years where you do really have a big move up. Also, I like to just short the Swiss franc. Tax deal failing in the U.S. is another view. Probably not a lot of people are talking about this. Probably a lot of people still think that some deal somehow gets done at some point. It's just in what way it kind of looks. This one from Jimmy W. NASDAQ does 100% in 2018. It's done 32% year to date. And this was basically what it did in 1999 prior to the dot-com burst in 2000. I guess the point here is actually some of the moves that we saw during the dot-com were actually a lot bigger, more than we've seen now. And another one here is Ethereum overtakes Bitcoin as being the most valuable crypto asset in the world. They're currently at 150 to 44 billion. These are already stale because these figures were basically taken off of, I think, Friday. So these already would have changed by now. And on the tactical book, we basically stopped out of our euro-dollar short. This would kind of been in the money, out the money. And then, that move back up 119.32 definitely means we were, I think, wrong on this. No doubt about that. This U.S. belt up has failed to materialize. And I just can't see too much that could really bring back the U.S. dollar. Some kind of a combination of very, very positive uplifting from the Fed in the U.S., as well as very kind of negative contraction or reversal from ECB, the Bundesbank, and economic data in the Eurozone. And all of these things just don't seem very, very probable anytime kind of soon. Probably need a good 6 months, 9 months, maybe before any of that kind of potential changes. And on the strategic book, we basically added, this new kind of short, just put it above the previous Bund short. And this is kind of a view that Bunds are too tight compared to where global rates are currently and are going to be going. Strong economic German data, European data as a whole, posturing for ECB and Bundesbank. Have the stop at 165, short from the close on Friday, 162.86. Ideally, kind of targeting something kind of 160.42, but it's again probably one to trade kind of in and out of. And with that, let me please pass it over to JK for the chartography. Thank you.
Thank you, Kay. Starting off with the US dollar index, we can see that the index failed to hold its 200 weekly moving average, and this week threatens to trade through the 2015-2016 base, which it did several months back, and an attempted recovery which followed back above this territory failed to push higher than we would have wanted, and looks as if this recovery has truly lost steam. Last week's trough sees the dollar trade at October's swing low here, which also corresponds to the 61.8% retracement. Below here this week, we have next natural support level to mark at 92.12. Now, 91.21, or the 2017 all-time low, is what the US dollar bears would want to see taken out for the year, which would potentially set up a continuation of losses in the new year ahead of us. We are expecting first topside challenge at 93.39, or a 0.7% gain from Friday's close, followed by the November downtrend. And only a break of the short-term downtrend is to then initiate a mildly positive bias. For now, given where Friday's low was, which was the October swing low, this session and next, risk is tilted for higher retracement. The euro gives the market a hint of the fate of the US dollar, though, as originally in what was developing into a negative backdrop, which all started with a break of the 2017 uptrend, which was then quickly followed by a break of a HNS neckline. But the recovery has been remarkable, as it most recently claimed territory above the short-term downtrend, and last week's rallied actually with ease beyond October's resistance, now trades above the 119 handle. Now, for those of us that was with us last week on our weekly macro call, would be able to recall that we marked support upon the retest of the September-October downtrend, and this happened to rest losses in the past week. The euro now faces two big challenges and tests ahead of us, which starts at 120.33, or the final September swing high above here at 120.90, or the 2017 all-time high. And a successful break above here opens further bullish gains. Strong support and buying opportunities would be presented upon a retracement to 115.60, which was October's resistance, this straight line here, and this was also November's resistance as well, that buy level 115.60 again. Now, we hinted on a neutral to a slightly bearish tilt last week as the dollar CAD looked to threaten the September-October uptrend, which indeed, and suffered two settlements below here, which constitute a valid break. It has also produced its first lower swing high, which reaffirms a bearish outlook. And just to highlight the significance of where this September all the way through to October, where this rally ended, the retracement of September lows, this happened to stall at the halfway mark between the May's highs to the September low, this 50% retracement. So any move in general which fails to push beyond this 50% retracement level signals a potential reversal, which is slowly in the making for the dollar CAD. Now, we wait patiently for a tactical bounce and look to sell the 127.52 rally. So the sell level will be at 127.50, 127.52, stops to be placed above 128.34, or above that first lower swing high, and a move back to this swing high takes the dollar CAD comfortably above the uptrend it broke as well, 125.90, or October's original resistance. Double top will be the profit target on all accumulated short positions. I wanted to share this chart of the dollar Swissy, which now trades at an interesting juncture. You can see that prices are now trading back at the June to August original resistance levels, which was first experienced as a result of the top to bottom 38.2% retracement. Now, whilst the technical picture does paint a negative outlook, especially as it failed its 200 DMA last week, it will be worthwhile monitoring to see whether last week's lows will continue to be defended, given the amount of noise experienced here from June throughout August and also a couple of times in September. The Aussie staged quite a remarkable recovery in the past week off its November lows, and saw its gains pause at the late October to the early November base. Now, another alignment of resistance at last week's high is proven by the September to October downtrend, and this downtrend is expected to continue to keep a lid on gains throughout this week. Now, our focus continues to be on the 2016-2017 uptrend. As we highlighted last week, we prefer to be on the bid just above the 75 handle. So again, anywhere between 75 to 75.10. This is where one can start looking at adding strategic long positions with two settlements or more below this long-term trend line to eliminate any long setup. Now, this is a pair I've yet to cover in the past, but thought that there was an attractive trade setup, given that it hovers below the September-October previous solid base level. We saw prices trade through this base in November. The most recent price action is seeing a quite consolidation below this level here, as it currently struggles below the 97 handle. So this leads us to initiate a bearish outlook over the Aussie CAD, with all short positions to be unwound upon two settlements above the 97 handle. So until we see two settlements back above this original September to October base, we will remain short the Aussie CAD. 95.40 is where we would unwind all short positions. The dollar yen closes out the week below its 200 weekly moving average, which prevents us from starting the week with a positive view. The daily chart shows that prices now sit below the 200 moving average, daily moving average as well, which again restricts us from turning positive. Although last week's selling, which pauses ahead of the 50% retracement between the September low to the November high, does give some dollar yen bulls some hope for the week ahead. Now, first upside test is at 111.60, or the 200 DMA, which I believe is trading very close to here in Asia. Above here lies the 112 handle as next set of resistance. Now, we need 111, this level here, to hold again this week. Otherwise, it's expected for selling momentum to get the steam. Below here, it easily opens 110 as the next downside target. New highs for the S&P 500 as it firmly hovers above a rising trend. Now, I've lost count as to how many times I've seen this year, but I must say I've seen this divergence on countless occasions. And for those that recall, I've shared this technical observation on many occasions, which what we dub an A-class divergence, which is marked by higher prices, but a decline in momentum is as measured by the RSI. Now, for now, as we head into the year end, one must respect the price action. However, this divergence here is something that we see again and again over US equities, and this continues to be an interesting reoccurrence. The S&P saw an encouraging recovery as it closed in on the 6,000 milestone once last week. However, it failed to hold this level for the week. That being said, the test for a higher bullish view to be formed is to see that ASX 200 close above 6,000 for the week. Crude continues its rally as it briefly traded through the 59 handle a barrel last week for the very first time in 2 years. Now, other than the very overbought status, as can be seen by the RSI, there is nothing to suggest a pause to this rally until starting at the 60 handle up to the 2015 peak at 62.58, and it's probably within these zones here where one can start to monitor for prices to potentially struggle initially before pushing higher. Lastly, on gold, nothing really standing out except for the mild resistance that's being seen here at the 2017 original double top, just below the 1300 handle, and it's probably above here that gold needs to close out above for the week to generate further buying interest. That concludes the charts for the week ahead. Back over to Kay.
Fantastic, JK. Thanks for that. And just going to put again here the link to the webinar for this Thursday. You can actually also sign up to Peter Garnery's, I believe, December 7th, webinar that he's going to be doing on kind of equity kind of update. I'm sure it's going to be his last one for the year. So again, it's going to be on Thursday 30th. Crypto kind of webinar focused, again, primarily on Australian clients, but anyone can obviously hop on to kind of register, and that will be 4 o'clock Singapore time, 5 o'clock Tokyo time, and 7 o'clock Sydney time PM. I'm actually embarrassed that I did not correct for this. I had this also last week. Just a recap, very, very busy week up ahead. We got OPEC. We got still focused on the German elections. We do have the U.S. kind of coming back in, which may give us some much kind of needed guidance. More importantly, the Senate will be in trying to hustle through the tax plan and see if they can kind of get that done in this side of the year. I still think it's more of a first 18 quarter kind of story. The US dollar was on the ropes 2 weeks back, but it looks like it's been knocked clean through. A lot of the crosses suggest that it's too much lower on the currency side, and commodities much higher as well from that kind of perspective. We probably think the euro dollar continues to break the new highs. The big levels to clear are 120.33 and 120.90. On dollar Canada, we'd be looking to sell about kind of 127.50 levels, with stops at maybe 128.34, 129 maybe if you want to get a little bit wider, and we'd target 125.90. Dollar yen, potentially some straddles or strangles here could make sense being long that, because we just seem we're going to be in this kind of tight kind of convergent range. 111 is key. 112 is again resistance to the top side, with a break of 111 opening to 110, 109. And it feels like something has to give here over the next kind of, I think, 2 to 3 months from my kind of point of view. S&P, again, we've seen this bearish divergence kind of continue, as JK calls it, an A-class divergence. RSI is ticking lower, yet the S&P continues to make new highs. Again, I think it's better to maybe express downside on this by, let's say, playing the Nikkei, just because you don't have that dollar yen helping you kind of out there. But you do also have to bear in mind seasonal kind of year end, Christmas rallies, people trying to kind of catch up with their benchmarks and so on. We'd still advocate energy looking very still constructive, as well as a lot of kind of commodities. I think on gold, 1300 is still key level, but also due to the fact that we're going to have a Fed hike in about 3 weeks, gold and silver tend to do quite poorly about 2 weeks kind of going into the Fed hike. At least that has been predominantly the case in this kind of regime. So it could be a reason to kind of keep that. And just lastly, we had that kind of new trade initiated in regards to being short bunds, given thinking that markets may be getting ahead of itself in regards to kind of Merkel, the German coalition. At the end of the day, Eurozone's doing very well. Germany just is kicking tail and taking names, continues to go from strength to strength. And it's really all about ECB and Draghi next year, and the Bundesbank, who are posturing more and more towards less QE, more kind of QT, and rates globally are still going up higher, either way you slice or dice it. And with that, wishing everyone a fantastic week 48 up ahead. All the best, and have a great close to